Hey everyone, welcome back to our channel where we simplify complex financial topics to help you make informed decisions about your investments. Today we're going to talk about stock market volatility and how it relates to stock market risk. When we talk about the stock market, we often hear the term volatility, but what does it mean? Simply put, volatility refers to the frequency and magnitude of price fluctuations in the stock market. A stock is considered volatile when its price experiences frequent and significant changes in a short amount of time. Volatility can be caused by various factors such as economic news, company earnings reports, geopolitical events, and many other factors that can affect the supply and demand of stocks. For example, let's say that a company reports lower than expected earnings, which leads to a decrease in its stock price. This sudden decrease in price could be seen as a volatile event. But what about stock market risk? How is it related to volatility? Well, stock market risk refers to the possibility of losing money when investing in the stock market. It is a fundamental concept in investing, as no investment is completely risk-free. The higher the risk, the higher the potential reward, but also the higher the potential loss. Volatility is a key component of stock market risk because it represents the unpredictability of the stock market. The more volatile a stock or a portfolio of stocks, the higher the risk associated with investing in them. However, it's important to note that volatility and risk are not interchangeable terms. While volatility can contribute to risk, it doesn't necessarily mean that a volatile stock or portfolio is inherently risky. In fact, some investors may actually seek out volatility as a way to generate higher returns. Let's take a look at some examples to better understand the relationship between volatility and risk. Suppose you are considering investing in two stocks, Company A and Company B. Company A has a long-term history of steady growth with a relatively stable stock price that has only experienced minor fluctuations over time. Company B, on the other hand, is known for its volatile stock price that can experience significant fluctuations in both directions. While Company A might seem like a less risky investment, its lack of volatility could actually be a disadvantage in terms of generating higher returns. Meanwhile, Company B's volatility may present a greater risk, but could also offer the potential for higher returns over time. Understanding the relationship between volatility and risk can help investors make informed decisions about their investments and create a balanced portfolio that fits their investment goals and risk tolerance. That's all for today's video. We hope you found it informative and helpful. Don't forget to like and subscribe to our channel for more videos on finance and investing. See you in the next one.